Good morning and welcome everyone to another episode of Beyond Bitcoin. Deryck Graham here today and with Greg Galton, and we're both up at Singapore having visited the Token 2049, the biggest of the crypto events happening this year worldwide. So what did you think of it, Greg?
I thought it was a great event, Derek. Yeah, it was very well attended. 20,000 people there, a lot to learn and a lot of progress being made in the space, clearly.
And the general vibe is interesting because I've been going to these sort of large events since 2017. And in the early event days, you used to see really investors running on various platforms that were just wanting to speculate and wanting to get into ICOs and wanting to get into sort of the next. This is a building event. They are building products, building layer 1 protocols already built, of course, building DeFi products, going into Web 3.0 and looking at how to tokenize real world assets. So my view of it generally, positive, progressive, more professional and larger than 2023. The dominant nationalities were Asian and Indian origin for probably obvious reasons, and age-wise between 20 and 40 years of age, very driven to create, invest and build. Did you get the same feeling?
Yes, I did indeed. I think that we've been in crypto winter for quite some period of time. People have clearly still been building, and that's really all you can do in crypto winter is build. They're now seeing the sort of the green shoots emerging of potentially a bull market emerging, and we'll talk more about that later. And now they're excited about bringing their product to market and telling everyone about it. So I got a really positive vibe from the developers, the project founders about the next period of time going forward.
And when you look at market cycles, venture capitalists play an early part and an early role. So there's two things you can learn from venture capitalists, and that is if they're paying way too much for product, you're probably getting to the end of a market cycle when it gets a bit too bubbly because they're paying multiples far above what they should be paying. And in this particular case, they're not necessarily doing that, but they're saying that the VC market is crowded, despite the fact there's a lot of deals. Let's have a look at that comment, which was intriguing. We had Hashib Qureshi, who's the managing director of Dragonfly. We had Kyle Sammy, who's the managing partner of Multicoin, and we had Van Spencer, who's the co-founder of Framework Ventures. All agreed the VCs should now be looking towards Web 3.0 products. In other words, moving away from layer 1 and layer 2 infrastructure towards various DeFi products and layer 3 and Web 3 protocols. So that's interesting. What that's suggesting is that the investment for VCs is close to finished in layer 1 protocols. And for those that have listened before and we've spoken about the tech stack, layer 1, first layer, is blockchains. Layer 2, side chains that are transacting at speed. Layer 3, decentralized finance. And layer 4 is Web 3.0, or the next generation of web as we see it. So what they were saying is there's enough investment in layer 1 protocols, side chains, and there's a lot of replication that's happening in decentralized finance products, and they're looking for the killer apps coming from Web 3.0. And that to me indicates progression up the stack in regards to how those VCs are investing. We spend a lot of time focusing on Web 3.0 environments, and so it sounds like a logical outcome. What are your thoughts on that, Greg?
Yeah, I think it's just it signifies the industry maturing finally. I think the race to the bottom on the fastest L1, that's maybe still to be won or lost yet, depending on whether you're backing Ethereum or Solana. But clearly those chains are now approaching the sort of the zenith of their development. I think Vitalik put it very well when he talked about his inspiration for Ethereum was talking about digital cement and building digital castles in the sky. And that's really what it is. He and the L2 guys touched on this as well. They want the base layer to be solid, secure, not too many fancy bells and whistles, and they want to be able to put the bells and whistles on in terms of the dApps that they put on the chain. So that's really the focus now, is the layer ones are pretty much done. We don't need 8,000 blockchains or 80,000 blockchains. We now need to start focusing on these products, and which will attract the masses to the digital asset space, the cryptocurrency space. I think it's heading in the right direction for sure.
And of course, there are thousands of, and a lot of people are able to lift the original, of course, Bitcoin open source blockchain and develop their own blockchains. In some ways, that kind of sounds a little crazy because there are so many blockchains out there servicing this market. And what we're therefore getting along the way is, I think, a lot of replication, and obviously with thousands or hundreds and hundreds of blockchains, many of them will not survive. That's okay. That is part of this Darwinism on steroids, which I think this space is. The other thing that was interesting was that the venture capitalists talked about the need for hedge funds. I thought that was very generous of them, but of course we're focused on hedge funds, and we are a hedge fund. We have 2 hedge funds, and so therefore I thought, oh, that's interesting. What they were talking about is the fact that VCs invest in early stage. They need exits along the way. There needs to be a secondary marketplace for that to occur. And if you're going to have secondary marketplaces or volume, it's good to have venture capitalists able to sell to institutions and hedge funds. So that makes a natural outcome. But one of the questions they did ask, and I'm regularly asked this question, Greg, and that is that why isn't this industry just simply analysed like a standard industry with price earnings ratios, net tangible assets on your equity investments? All of them agreed that's unlikely to happen for a long period of time. Not because of any sophisticated technology aspect, simply because they said the investors are different. They're retail investors, they're early stage investors, they're believers in the future, and they're not looking at what the price earnings ratio is or the net tangible assets. Do you get that sense? After all, Greg, you've got like 20 years in research analysts in equities, and here you are in this space. Does that make sense?
Yeah, it does from a number of different perspectives. So firstly, you can't treat a cryptocurrency or a block one or a layer one or a layer two or a digital app. You can't value them like a company. It's a hybrid between a company and a currency. It really is. And tokenomics are really a very strong key driver of value enhancement and also value destruction within the industry. So the amount of emissions of tokens that you see coming out of a blockchain can really dilute an investor's returns. Yeah, they are hard to value. It's very much like valuing early stage tech. A lot of these protocols are pre-revenue, or if they're generating pre-revenue, they're certainly pre being cash flow positive. So it is very difficult to do a DCF on them. All you really can do is extrapolate a few sort of market multiples. The market's not that sophisticated. Crypto is one of the few markets where it's been the retail investors that have been the early investors. That's really unusual for traditional asset class. Normally it's wholesale investors, institutions that get in first, and then slowly that opportunity comes down to retail. This environment, it turns that on its head. It's retail that have been the big investors, and now slowly you're seeing the interest from hedge funds, from institutions, people with equity accounts wanting to buy Bitcoin on an ETF listed on the New York Stock Exchange. So that market is really very different. So it's very different demand drivers, and I guess that's reflected what we see in the volatility. There is no institutional buying when things sell off like there is in equities. That's why you tend to get these big moves down. So those are all certainly factors that are driving this. Plus, there's no fundamental valuations. We're dealing with magic internet money in reality still, and it's very much driven by the hype cycle. So yeah, I think it's going to continue like that for a little while more. It is becoming more sophisticated and maturing more quickly, but it's going to take time.
Yeah, 100%. And one thing we also had a long discussion on, and that is regulations. So for those speculators out there, or for those investors that are just enthusiasts, this is not a boring topic. Regulations are, for some period of time, considered regulatory risk. And the biggest regulatory risk, of course, in the last year and a half has been what we've often referred to as the SEC's choke point 2.0. But along comes the election, along comes Donald Trump, who turned around and said, Bitcoin, I love it. And all of a sudden, the dynamics changed. And what we're seeing now, according to some of the US panelists up there, one of them being Anthony Scaramucci, is that America is very polarized, as we know, red or blue in regards to the elections. But Anthony Scaramucci's turned around and said, I believe either way, whichever party, Republican or Democrat, there's going to be a positive outcome with regards to progressing the regulations. And he refers to as crypto as purple. In other words, it's neither red or blue, it's now both. That was a really positive statement to make. We already know that Europe and the US, Singapore, India, Korea are all either have their regulations in place or are rapidly building those regulations, but the world is dominated by the American view. Did you get that sense too, Greg?
Yeah, I think the concern was that crypto could become a partisan issue, and the panel was really hopeful that it would remain bipartisan, that you would see positive progress regardless of which side got in, whether it was Harris or Trump. And I think with Jeremy Allaire from Circle, he didn't see so much of a risk in terms of who got it, in terms of the regulation change and the legislation change going forward. But I think he's probably taking a more of a long-term view. He's a stablecoin provider. I don't think he's really all that impacted. So he was like, oh, if they don't get it right this cycle, they get it right next cycle. But for most of us, we can't afford to wait the next 4 years for the US to get this right. They need to get the regulation right now, or get it correct. And there's plenty of models where that's been done already. So, talking about copy pasta and taking what the European entities have done. But I guess the US, there's so many regulatory agencies that operate in the US, both at the federal and state level, does make it very tricky, and it is very much driven by who sits in the White House and who they appoint to these various entities, various agencies.
Yeah, I mean, on the subject of that, he really can afford to wait, because we saw Jeremy walking into the very first event on the second day, and it was an impressive thing. I haven't seen this sort of thing for a long time, because he had security guards in front of him and security guards beside him and security guards behind him. So it was like the arrival of a rock star as he arrived, yet there was hardly anybody around because he was walking down empty halls. But he's obviously a man of great wealth and great importance to have so much support like that in security guards along the way. I'd say, to round up, what were your thoughts? I found the entire event absolutely scintillating and enjoyable, and I don't always find those events. Certainly, I've got to say, Token 2049 in Dubai was obviously a washout. It was just nowhere near as impressive as this event was. But I felt this event was very upbeat and very professional.
Yeah, I think some major news announced. You had MakerDAO rebranding to Sky.money, and then that coincided with the release or the announcement by BitGo that they are releasing a new stablecoin called USD Standard or USDS, which is a new approach to stablecoins. So it's one where you're able to earn, I believe on Sky Money, you're able to earn the Sky token if you hold USDS within their platform. So it's a stable coin that's more geared towards rewarding holders, which I think is a positive move. Stable coins are a key part of the industry, and then so is DeFi. So that was interesting. Solana came out with their new mobile phone, really wanting to make that the crypto phone. I don't think it's being released until next year, but a lot of work and time and effort to really make that an all-in-one crypto device. That's all you need, actually, to be able to operate wallets and switch between your primary account and your burner wallet. And look, an interesting product there. You had Charles Hoskinson from Input Output talking about this new decentralized identification protocol that they're working on. That's interesting because privacy is a key issue for a lot of people. You look at corporates with treasury management. Do they want everything that they do on the blockchain being seen by everybody else? No, they probably don't. There was a lot of talk about payment rails and stablecoins being used for payment rails for corporates, but not if they don't have privacy, they won't be doing it. Yeah, there's still a lot of challenges to go. The AI presentation by Dr. Ben Goertzel was really interesting. He had a couple of AI robots on stage with him. You could tell that they weren't pre-recorded. They made a few mistakes. They got a little bit confused, which was really, his interaction with them was really stimulating, really exciting to watch. And he's extremely positive on the outlook for AGI, for AI, moving into AGI, which is artificial general intelligence. So that was really interesting. So yeah, the outlook looked particularly bright. You had Chairman Powell come to the party and give us a 50 basis point rate cut overnight. That saw Bitcoin up 5.5%. That put an extra sort of step in everyone's shoes around the conference today. And everyone's expectation the fourth quarter of this year is the start of the bull market. So we're only a couple of weeks away from that. And let's see how things progress from here.
Yeah, very much. In fact, one of our favourite presenters there, of course, was Anthony Scaramucci, a real character, an active investor, a believer in crypto, and also he's an advisor to the Democrats now in regards to how to set their regulations going forward. And he was asked the question, where are we in the marketplace? And again, he said, we're at the very beginning of a bull run that's likely to be in the quarter four of 2024, in fact more so in October, November 2024, and it's the very beginning of a long bull run. So a very positive statement from Anthony Scaramucci, who's always has a pretty solid view of things. And yeah, that's it from us here at Token 2049 at the end of 2 days, and in our case, many side events, many evening events, and our own presentation, which we had dozens of people attend, which was great. Very vibrant city is Singapore in this world of crypto assets. If anyone is in this world, loving technology, loving the investing in this space, I highly recommend coming to Token 2049 in 2025, next year. But for now, goodbye from Singapore, and thanks for being here with us, Greg.
Okay, been a pleasure. Thanks, Deryck.
Bye for now.